Welcome back to my Accounting 1120 discussion on long-term debt. And just in case you're interested, it's snowing like crazy and it's a frozen hellhole out there. Just in case you're interested, let's continue our discussion on bonds. My goal now is demonstrating the accounting for a bond sold at a premium. It sold at 103.63. Let's bring forward our facts, so I'm pretty sure you're good at them by now. Here's our indenture. We're going to borrow $10,000. We're going to pay interest per the terms of the bond indenture. Can't be changed. They're outflows to us every 6 months, and then we're going to pay off the principal of the bond as well. So here's the indenture, and here's the cash flows of our bond. And notice the market is yielding 8%, and that brought us to the 103.63. It's correct. I calculated it out, but we're not going to show you how to do that. It's beyond the scope of this book. What you do need to know is the way you calculate the price that you're going to get for the bond. The cash is times it by that 103.63 I gave you above. And that tells you you're going to get $10,363 for the bond. So where I got it doesn't matter, but you do need to use it. So, true to our nature, let's analyze the situation by creating an amortization schedule. This time I'm going to do it because it will yield useful information to me. Let me put you on hold and put down the format. So here's the format of my amortization schedule. Keep track of our dates, the cash paid, and as you already know, the cash paid is going to be $500 for every payment, and there's going to be 4, because that's determined by the bond indenture. You know the dates. We're going to issue the bond on 12/31/12. and then pay interest on 6/30/13 and 12/31/13 and 6/30/14 and 12/31/14. And you know that we're going to start at 10,363 because that's what we sold the bond for. Now I'm going to leave you with me while we figure out how to do this. So it starts at 10,363. The cash is always going to be 5% of the face value of the bond. The interest is going to be the 4%, which is half of the market rate. Remember, it's semi-annual. Don't put 8 here, put 4 here. This was 10 and we dropped it to 5. This was 8 and we dropped it to 4. Now take the 4% of the 10,363 and times it. That comes up to $415. That's interest at 4%. You're paying interest at 5%, but you charge them an additional $363 to offset it. So the difference is going to come out of that cash that we tucked into the bond premium account. You'll see that when we make the entries. The difference is $85, and I'm going to drop the carrying value by that because I have now used it up, and the bond's carrying value after that first payment will be $10,278. The carrying value is changing by the amount I'm amortizing. So that takes us through our first payment. Let's do the next one. We pay $500, 5%, 10,278 times 4% gives you $411. And the difference between 5 and 4% this time is $89. So I'm going to use up $89 of that premium, and my carrying value at this point will be $10,189, and that takes us to 12/31. Let's go out another 6 months. 10,189 times 4% is 407. We're actually paying 500, so we're going to use up $93 of that premium. That will bring our carrying value down to $10,096. Aren't you glad this isn't a 30-year bond? $10,096 times the 4% would give me 403. And that would give me 97. But you can see I only need $96 to go away. So I'm going to plug that. In accounting, we do that when we need to fix an amortization schedule for rounding, since I'm using whole dollars. So I'll make the amount I amortize be 96, and the amount I call interest 404. I'll amortize that 96 off, and we're down to the face value of the bond. And our amortization schedule is complete, and it worked. Now that we've done that, we can start journalizing. So you put the amortization schedule away and you use it every 6 months when you make journal entries. Let's start at the beginning. We get cash on 12/31, and I've got the year right now. Don't make fun of me. I'll get cash in the amount of $10,363 because I'm selling it at a premium. And the $363 will be used to offset interest in the future. Debit cash for $10,363. Set up the bonds payable premium, so we'll say premium on my bond, $363, and bonds payable, $10,000. It always gets the face value of the bond, and we have recorded issuance of the bond. Now, what happens on 6/30, our first interest date? On 6/30/2013, we're going to have some interest expense. We're going to amortize some of the premium on our bonds payable, and we're going to write a check. We're going to write a check for $500 because we always write a check for $500. Interest, however, is at 4%, and it's $415. And the difference we're going to take out of that premium and use it to offset interest expense. Interest expense is not $500, that would be 5%. It's $415, that's 4%. And we've recorded that line of the amortization schedule. Let's move on to the next one. 12/31/13. Interest expense is going to be $411. We're going to amortize out of the premium for bonds payable, $89, and we're going to write the check for $500. How about you put me on hold and make the next two journal entries? The one for 6/30/14's interest payment, and the one for 12/31/14's interest payment. Then come back and see how you did. How do they look? Do they tie to the amortization schedule? Mine do, yay. There's one more thing that happens on 12/31/14. We honor our obligation by paying off the bonds payable in the amount of $10,000 and writing a check for $10,000. Let's take a minute now and see what's happening in the general ledger, in the bonds payable account and the bonds premium account. So bond premium on bonds payable, is an adjunct account. Means it adds to another account, in this case the bonds payable. If it deducted from it, it would be a contra account. That's what a discount account is, a contra account. This is an adjunct account. We put $10,000 in our bonds payable and $363 from premium with our first journal entry. Then in our second journal entry, we amortized 85 of that bond premium away, and in the third journal entry, we amortized 89 of the bonds premium away. If you get a total right here, that's 189 at that point in time. I'm going to come back to that. Let's post the other 93 and the other 96, and the bonds premium is down to 0. And then you pay off the bonds payable and it goes away. That's how it looks in the general ledger. How does it look on the balance sheet? Well, the balance sheet under long-term debt would show the bond payable at $10,000 the entire time. I want to come in and see what it would look like on 12/31/13, right here. And I grabbed your bond premium account at that time when we were posting, and the premium on the bond would be at $189, as you can see. So on the balance sheet, the bond would show at $10,189 its carrying value. And notice that that ties to our amortization schedule as well. Well, this was demonstrating the accounting for bonds sold at a premium, sold 103, and it was on the effective interest method. The effective interest method says you'll set up a schedule and you amortize the bond using the actual interest rates. There is a simple interest method that the author talks about. Let's look at bond amortization for a premium using the straight line method, which is not the interest method, but it's not generally accepted accounting principles if it's a bond of any size, and they always are. But I'll demonstrate it quickly because it's mentioned in the chapter. I'm still going to use our bond sold at 103.63 and still use a $10,000 bond. So you know the bond sold at $10,363. I'm not going to make an amortization schedule because it's too simple to do this. Without, I see no point to it. Here's our entry to record the issue of the bond. Cash, $10,363. Premium on bonds payable, $363. And bonds payable, $10,000. So nothing's changed with our first entry. On the straight line method, you just write, can't spell today, you just write the interest off evenly over each period. We're going to write 363 of premium off over 4 periods, so divide that out. When you do, it comes up to 90.75. So I'm going to go with 91 3 times and round the 4th payment. So the entry to record each interest payment which is paid every 6 months is going to be interest expense, premium on bonds payable, and cash. And you know what the cash is going to be. It's always $500. And the premium is going to be written off evenly at $91 for each payment. So the interest expense is going to be the difference. 500 minus 91 is 409. So you would make this entry 3 times, and on the 4th time you'd need to adjust it a little. Where would we be on the straight line method in the premium account? Premium on bonds payable started at 363, and the first time you took out 91, and the second time 91, and the third one 91. How much is left in that account? And the answer is 90. So the last entry would plug that, and it would be interest expense of 410, premium on the bonds payable in the amount of 91, in cash. The straight line method is very easy to use, but it's not generally accepted accounting principles. So you have 2 ways you can amortize. the straight line method, which your author demonstrated in the chapter, and the effective interest method. Forgot that. Which is what we did just prior to demonstrating the straight line method. Straight line method, as a general rule, is not generally accepted accounting principles because the dollar amounts are always significant. If they're not, you can use it. If they are, you can't. So we always pretty much default to the effective interest method, which is the first one that you learned on this pencast. So, there you go. Thanks for joining me.